thanks to everyone for joining us this afternoon for our CIO Insights session called Stay Ahead of the Curve. I'm delighted to welcome our Chief Investment Officer, Justin Onakusi, as well as our Head of Economic Research, Hetal Mehta, to speak to you today. Upon registration for this event, attendees were asked if they would like to submit questions in advance. In due course, there will be around 20 to 25 minutes of slides covering a range of topical issues that came up in advance, after which I will also ask a number of questions to both Hetal and Justin on your behalf as well. There were so many questions submitted that I've tried to group into themes, and these will be covered in either the slides or the questions that we run through in the second half of the session. Because there are so many people online this afternoon, I hope you will understand why we can't run a live Q&A, but we will cover what you, the audience, has told us that you want us to cover in advance. So to start the conversation, Justin, should we start with you with your opening comments?
Thank you, Darren. So 2024 was the year of the election where over 50% of the globe went to the polls and voted. And what was clear that in developed markets, what you saw was the incumbents either lost their seats or lost electoral share. So what does that mean for 2025? That means that essentially the incumbents who have lost electoral share, or the new person that has come into power, such as Keir Starmer in the UK, such as Donald Trump in the US, it's clear that voters have voted for change. So the likelihood is you're going to see policy that is unconventional, different from what we've seen historically, different from the status quo. That has a read through to markets, and therefore 2025 we believe will be the year of fat tails. What does that mean? It means more extremes on both the upper and lower end of the return spectrum. So you're likely to see more volatile returns throughout 2025. And I do think the way you think about managing your portfolio, therefore, has to be done through that lens. As you said, Darren, my name is Justin Onakusi. I'm the Chief Investment Officer here at St. James's Place, and I'm going to talk to you about fat tails. Then I'll move on to talk about the overall, our views, in particular, our house view. Hand over to Hetal to talk more about the economics before handing back to me, and I'll talk a little bit more on markets overall and what things people can do to make their portfolios resilient in the volatility. So go to the first slide, Darren. So in terms of performance, I'll start with the pink bars here. So what we've got here is just a range of different asset classes, ranging really from the low risk asset classes on the left hand side, so being bonds, to the high risk asset classes on the right hand side, being equities or shares, as they're often called, and actually focus on the 5-year annualized number, the pink bars. So the pink bars, if you look at the pink bars, what you can see is actually disappointing returns for bonds on the left hand side, positive returns for equities, but there is one real leader here in terms of overall performance over 5 years, and that's US equities, significantly outperforming other regions over that 5-year time horizon. But as always, the best performers tend to be vulnerable, particularly at turning points, and that's exactly what you've seen year to date, where the US has been the worst performer versus other regional equity markets, with the exception of Japan. The other thing to note is the role of bonds in portfolios, and I'll talk a bit more about this later on, but you can see year to date that those bonds have provided protection, particularly relative to the US, as the US has delivered meager returns year to date. And particularly when we've seen the falls in markets, those bonds have provided protection. So really important, bonds do have a really strong role to play in portfolios in volatility. Moving on to the next slide, Darren. So this is really, if you are investing, it's important to understand what are the key variables that lead to strong returns over the medium term. So valuations are the key input for us when we think about medium-term views, when we think about medium-term returns. And I'm talking medium-term here, like for 3 to 5 years. So the typical time horizon for an investment cycle. So essentially, valuations are the key driver of those kind of 3 to 5 year returns. So what does that mean? Cheaper asset classes tend to perform better over the medium to long term. However, you cannot invest in cheap asset classes blindly. You have to think about what are the key moderators to that the asset class dynamic. And we've got really 4 moderators that are really important to think about when investing in asset classes overall. The first one is fundamentals. So what is earnings growth doing? What are the key trends in the market, such as AI today is a key one. Behavioral flags. So really importantly, understanding where sentiment is positioned. And typically you want to be on the opposite side of that. So if everyone's in a certain asset class, you typically want to be on the other side of that, because that's when, again, when you get the movement from overweight asset classes to underweight asset classes, that you get that kind of strong medium-term return. Tail risks. So these are risks which can completely derail the economic cycle or the asset class dynamic. And finally, the economic environment. And that's what Hettel's going to cover a little bit later. But before she does that, I'll cover one more slide. If you go onto that, Darren, and this is my fat tail slide. So essentially, if you think about the blue or the turquoise curve, focus on the dotted line. You can ignore the left-hand side numbers on the kind of the vertical axis. Just focus on that dotted line. That is the average outcome, so the average return that you will expect from a particular market. And what you can see with that blue curve is that lots of the different observations are around that dotted line. What fat tails mean is essentially this orange line where, okay, you still get a similar average outcome, a similar average return, but the returns tend to be more dispersed. In particular, what you see is right at the end on the right-hand side, on the left-hand side, you see more extremes on both, from both a negative perspective and a positive perspective. Really importantly, when you think about fat tails, they're not necessarily all negative, because you can get significant positive returns. But interestingly enough, if you have any asset classes that are consistently underperforming, so in that left extreme fat tail, actually that's when these asset classes may become more interesting. That's when these investments may become more interesting, because actually by being in that kind of left-hand fat tail for a significant amount of time means those asset classes become cheaper over time. And we know, as I said, the cheaper the asset class, the stronger the medium-term return. So with that, I'll hand over to Hettel to cover the economic cycle, and she'll hand back to me a bit later where I'll talk about the house view and opportunities and risks in the market. Hettel.
Cool. Thanks, Justin. So I'm going to start by outlining our economic scenarios. It's worth highlighting that we don't do economic point forecasts here at SJP. We think that, you know, even big institutions with an army of economists, whether that's the Bank of England or the Federal Reserve in the US, you know, forecasting can be very difficult. So instead of those point forecasts, whether inflation next year will be 2.2 or 2.3, it can be really a kind of thankless task. And so we really focus on scenarios, probabilities, and ranges. And that's our approach to thinking about the economic situation and the risks around that. Now, we have recently changed our scenarios, but let me tell you about our previous scenarios, which we implemented, I think, the day after Donald Trump was elected, we moved to a kind of soft landing base case, attached a 60% probability of that, and then we had a kind of 15% recession risk, and we still had some upside, this idea of a reacceleration where maybe we saw tax cuts coming through, so we could have stronger growth, bit more inflation, but also stronger growth, and that was the way that we saw the lay of the land. We had a lot of uncertainty going into that election, and then once we knew who was going to be heading the US government, we had an idea of what those policies could look like. Now, roll forward a few months, and we've had a lot of policy flip-flopping. We've had probably some of the economic data has started to actually also react to the heightened uncertainty that we have in the current environment. There are ways of tracking economic uncertainty, certainly a way of kind of constructing an index of news articles that reference economics, uncertainty, policy changes, and those are actually quite elevated at the moment. And taking that into account, taking into account that businesses are feeling less confident about the outlook, we thought it's important to reflect that in our risks, and so we have increased our recession probability from 15% to 35%. But just to help break it down, kind of try to explain that actually the biggest part of that 35% is actually mild recession. The US economy has been performing quite well. We've had very strong growth the last couple of years, even when many economists thought a recession was likely to hit in the aftermath of the Russia-Ukraine energy increases, interest rate increases. The US economy has actually held up very well. We've had about 3% growth over the last year or two, and so that has certainly helped, and so some sort of slowdown is likely, but mild recession from here would actually just mean a more pronounced slowdown and a short-lived recession. And the idea of a deep recession, we think, is actually still quite a small probability. That's 5%. So that for us is actually something we don't actually envisage as being very likely at all. And then there's this middle idea, this stagflation, where we have weaker growth but also high inflation, and that's something we can't discount or dismiss as a possibility, given we have, and I'll come on to talk about the recent tariff announcements, but we have a number of things that may be pushing up inflation, and the impact on growth may be negative. So we kind of wanted to introduce this stagflation scenario just so that we can articulate where we think that balance between growth and inflation is. But our soft landing scenario is still the base case. I just want to reiterate, it's not all doom and gloom. That is 50%, and there is still some upside risk. We've just taken down that upside from 25 to 15, partly because of the idea that tax cuts would come and help boost the US economy, I think, looks a little bit less likely currently. It's not clear whether the money that the US government will generate from the tariff increases can be recycled into lower taxes, but it's still a possibility. We just think it's slightly less likely. So yeah, that's a kind of very broad summary of our economic scenarios. And then we also track where we are in that overall cycle. So economies go up, economies go down. Recessions are periodic every few years. It's normal for economies to experience that. And as Justin said, where we are in the economic cycle is one of the things that features in terms of how we look at asset classes, which asset classes are likely to perform under different situations. And we think we have moved closer to recession, which is reflected in the probabilities versus where we were a few months ago, but it is still not our base case. And this late cycle phase can last for a long time. It's not guarantee that you only go from late cycle into recession. There can be many policy announcements that keep you in late cycle for a long time, that maybe bypass recession altogether, and you see that really big acceleration. If we saw aggressive tax cuts in the US, it's very possible that you see strong economic growth resume and you bypass that recession. So I just want to make that clear in terms of where we are, but the chances of us moving into any one of these situations, it's not a foregone conclusion. Now, if we look at the next slide and think about one of the biggest issues facing the US economy, and indeed over the last 12 hours, it feels that the whole world is trying to digest exactly what the Trump administration is trying to achieve with the tariff announcements. The really important thing to think about is just the amount of uncertainty, and I think we also have to be humble around our ability to predict certain things when policy is changing a lot. And this uncertainty index just goes to highlight just how difficult it is in this environment to have any kind of clear view regarding trade policy. So this is an index about trade policy uncertainty, and it has never been this high. The index has been running for quite a long time, I think since the 80s. During Trump's first term, when we also had tariff wars, this did pick up, but I don't think it breached even 100. And now we are north of 450 on that index, that far left chart. So it just goes to show the scale of the confusion, if you like, around what the outlook looks for US trade policy. Now, one of the things that we've had announced is a new set of tariffs. There have been several announcements since President Trump took office at the end of January. But the key thing that we've had now is the administration's attempt to levy tariffs on countries according to the trade deficit that they run, or the trade surplus. And so countries that the US has a big deficit with, China, EU, Mexico, for example, that's where the US imports a lot more than it exports to those countries. So that big deficit, they're the kind of target countries in the first instance, but actually what we've had announced is very broad. So I think over 100 countries and territories have been affected by the latest announcements, including the UK. So the UK now faces a 10% tariff on anything it sells into the US. So we see this trade balance that gives us some idea of which countries, from the US's perspective, are the ones that they feel have the biggest advantage from the US perspective, that those countries are selling much more to the US than the US is buying. And so that's been one of the ways in which they've levied the tariffs. Now, when we try and think about our growth and inflation mix, the key thing here is the average tariff that the US consumer will face. That's what the chart on the right-hand side is showing, the average tariff on goods imports. Now you can see over the last century or more, the general direction of travel has been lower tariffs. We've had lots of free trade agreements signed. We've had the integration of China into the World Trade Organization. So the idea is to have free trade. Countries specialize in various goods and they sell to each other, and that should bring overall inflation down globally. What we've seen now is this sharp increase in tariffs, which could take that overall tariff rate up into something around the 20% mark. So a 20% increase in terms of prices on anything that comes into the US via international trade. For each percentage point increase in that average tariff rate, that will translate into a 0.1% increase on inflation. And that's an estimate. And And so you can imagine that with a 10% increase, then that means a 1% increase on inflation. And when inflation is around 2.5%, 3%, a 1% increase on that is quite material and obviously pretty important for the central banks. And we do think that this will make it much harder for central bank, particularly the Fed, to be able to cut rates in this environment. So they will focus on growth. If growth weakens, they will want to cut rates, but they'll be probably constrained in how fast they can cut if inflation stays high because of what's happening on tariffs. So let me just move on to the UK, just to give an idea of how the UK economy, obviously close to all of us, is evolving. One of the things that is, I think, notable is just how lackluster UK growth has been after that kind of initial COVID recovery. So when you look at monthly GDP data, we obviously saw big decline during the pandemic. We saw a big recovery, but it really hasn't been able to keep up at that kind of sort of trend that we had achieved in the kind of 5-6 years in the run up to the pandemic. And so that weakness in the growth numbers will have obviously a bearing on many other aspects of the economy, including what the Chancellor is able to do in terms of fiscal spending, in terms of tax policy. And we had the spring statement last week where the government was able to leave taxes largely unchanged, but we have seen that because the borrowing numbers have been higher than they would have previously liked, that we've actually got this spending restraint in the years further out. So in 3 to 4 years' time, the government will be showing quite a lot of spending restraint, which means that that boost to the economy is not really coming through. It's a very kind of constrained picture, and it does mean that the fiscal policy is vulnerable as we kind of get to the autumn budget. There is a chance that taxes may have to go up. There's a chance that the Chancellor may revise her fiscal rules, and the speculation between now and autumn is probably likely to continue. And then just finally on interest rates, the situation for the Chancellor is also dependent on what's happening on interest rates. We do still have high inflation here in the UK. Even though the Bank of England is cutting interest rates and I think will continue to cut modestly through the course of this year, we have to also remember that for a lot of people that have mortgages, that they will be rolling on to higher mortgage rates. So if you had a 2-year mortgage fix, maybe that you got 2 years ago and that's rolling off, you might roll onto a lower interest rate mortgage. But if you've got a 5-year fix, and the vast majority of mortgages in this country are longer term 5-year fixes, you may be rolling onto a higher interest rate than where they were. And so that is something that will also constrain economic growth in the UK. I'll leave it there, but obviously I think we've got some questions that we're going to take, so I can answer some more then.
Thanks, Hettel. So I said I was going to talk to you about opportunities as well as risks, and we do see a number of opportunities in the world at the moment. So this is the SJP house view, so driven by the investment team, so driven by the valuations and all the moderators that I went through before, including what Hettel went through in terms of the economic cycle. So really there are 6 asset classes which drive anybody's portfolio, and it's these on the left-hand side. So getting these asset classes right is really key to driving any individual's portfolio overall. In terms of priority and the importance, equities, so how much shares you have in your portfolio, are clearly the biggest driver of risk overall. But the second biggest risk, and sometimes underestimated, is how much pound sterling you have in your portfolio. So how much UK assets you have relative to non-UK assets. Really, really important when thinking about your portfolio overall. So the way this works is you've got a double negative, and if you are a double negative, then we hate that asset class, we despise that asset class. A single negative is we don't like you. Neutral is that kind of line in the middle. Single plus, we like the asset class. Double plus, we absolutely love the asset class. So you can see on the house view, there are two asset classes that we like. Emerging markets, which we used to love, but has come down from a double plus to a single plus over time, and pound sterling. Why do we like pounds? Because pounds are cheap. So you look at sterling relative to the dollar, relative to the euro, pretty much since Brexit, since 2016, sterling has looked cheap. So therefore, we're biasing the portfolio towards more pound sterling assets. And then you get more granular on the right-hand side. In particular, one of the things we're looking to do here is take diversified positions, or when we think about our house view. So you see an underweight to the US. I'll come on to talk a bit more about that and why that's so important in this fat tail environment. But you'll see we're positive on pretty much all of the regional markets outside of the US. So UK, Europe, Japan, emerging markets, and we do like smaller companies as well, mainly because they look very cheap relative to larger companies. So positive on all those regions, negative on the US. And I think it's really important when you think about fat tails is to think about how to diversify your portfolio, how to make your portfolio more resilient. And that is part of the reason that we're underweight the US. So I'm going to talk a little bit about that underweight to the US now, and then move on to the importance of bonds in creating a diversified portfolio. So Darren, you can move on to the next slide. So first, the importance of diversification. So what this chart, this patchwork quilt shows. So typically it shows the performance of different asset classes ranked year after year. So in 2016, high yield bonds were the best performer, cash was the worst performer. In 2023, it says DM equities, developed market equities, were the best performing asset class out of this segment, and commodities were the worst performing asset class in 2023. So what we try to do within the portfolios that we manage, such as Polaris, such as in retirement, is we're trying to create a diversified portfolio by bringing together all of these asset classes in one portfolio overall. And you'll see the gray portfolio box in the middle. So essentially, when I talk about Polaris, when I talk about in retirement, we're tilting to, we're taking a diversified perspective, holding all those asset classes in the portfolio, and then trying to tilt towards the best performing asset classes over the medium term. So trying to be in the top half of this patchwork quilt to some extent. But what do fat tails mean to the patchwork quilt? Well, ultimately, they mean that the top performing asset class and the bottom performing asset class are likely to have a much wider range than they have kind of historically, because you're going to see more of those types of extremes. So it's just re-emphasizing, when you have that wide range of asset classes, it's important not to try and be concentrated, because it's very difficult to predict what the impact of policy making is going to be on asset classes. So try to be diversified, try to create a resilient portfolio, and try to be in that gray box, spreading your risk over the different asset classes year after year. So moving on to US equities. So another patchwork quilt, this time just taking 7 different equity markets or share markets, ranging from US, China, Japan, and again, just ranking them from 2017 year after year after year. You will see that essentially for most of that period, apart from 2, the US has been either the top performer or the second performer. So what has this meant for global share markets or global equity markets? Well, it's meant that over time, the US has gone from being 40% of, or just below 40% in terms of the size of the US as a percentage of global stock markets, and now it's almost 70%. So that outperformance of the US that I mentioned on the first slide has meant the US has become more concentrated in global markets, and now it's just below 70% in terms of overall exposure proportion of global equities. So global equity markets have become more concentrated, driven by the US. Moving on to the next slide, because it's not just about the US becoming a larger proportion of global equities. Actually, within the US, you've also seen the top 10 stocks, as we've got here, go from being 20%, this blue line you see, in 2012, to almost 40%, or between 35 and 40% today. So stock concentration, the top 10 stocks, it's an S&P 500, so a 500 stock index. We've used the iShares to do that. So this is a common fund which holds all 500 stocks in the US. You can see that the top 10 stocks have gone from 20% to almost 40% today. So significant amount of concentration. You think you're getting 500 stocks, but actually you're getting a concentrated 10 stock portfolio, which is dominating that 500 stock portfolio. But not only that, the US has become a bigger proportion of the rest of the world as well. So when thinking about diversification, when thinking about making your portfolio more resilient, of course, we've been moving away from the US. That's one of the reasons you see a negative on the house view in the US, and we've allocated that elsewhere. What does that mean in terms of portfolios? The next slide, Darren. So it's an example portfolio here. We've used one of our multi-asset funds. So how does this house view impact our portfolios? So you see the regional weights on the left-hand side, and you see actually we've got 51% in the US, and you might think, well, if you're negative on the US, why do you have so much in the US? But actually look at where the benchmark is. Look at where the market is. We actually have 16% less than the market in US equities, US shares, and we've got an allocation you can see to Europe, to the UK, to emerging markets, where we have a greater amount than the market. So really, really important. Negative on the US doesn't mean we don't hold the US, because the US is such a large proportion of global stock markets. It just means we hold a lower weight than the market. Really, really important. So that's how we're diversifying in our portfolios. The last thing I want to leave you with is the next slide. Actually, second to last thing I want to leave you with is the next slide, which shows essentially the blue bar. I won't go through what the indices are because it's probably less relevant, but the blue bar is equities, so global stock markets. And you can see that periodically, typically that blue bar is positive, but sometimes that blue bar can be negative. The orange bar is bonds, and we look at, going back to 2001, and the orange bar is bonds. And what we've just simply done is we've highlighted all of the negative returns to equity markets on a yearly basis, and you can see that in every one of those negative years, when the blue bar has been negative below zero, that the orange bar has typically been positive, apart from in 2022. So ultimately, bonds have provided protection to equities. So when thinking about your diversification, when thinking about your portfolio resilience, I think it's really important to think about bonds and the role they play, particularly if recession probabilities are going up. Even though we don't think there's going to be a recession, just recession probabilities going up does mean that when you see these fat tail moments in equities, bonds can provide protection relative to your equity portfolio. The very last thing I want to leave you with, we've spoken about the importance of diversification. We've spoken about the opportunities in the market, which we think are outside of the US overall. It's really important to recognize that when you have these periods of volatility, this is when the typical investor's behaviors can impact their long-term portfolio, because people become fearful, try to take the money out of the market. Ultimately, this is destructive from a portfolio perspective, and can impact your overall pension savings, your overall wealth. So it's so important to remain in the market overall. And this chart tries to show that. So you go back to the end of 1986, if you had £100,000 and you invested that in the UK stock market, by today, the overall value of that £100,000 would be £3 million. So significant increase in the overall size of the pot. However, just missing the 10 best days. And remember, fat tails mean extremes, so positives and negatives, but missing those top 10 days would have led to the portfolio, or your portfolio only being £1.5 million, still a lot of money clearly, but £1.5 million less than if you just captured those top 10 days. And those top 10 days tend to happen in periods of volatility overall. So as I mentioned, 2025 is the year we think of fat tails. This does mean more extremes. So really important to think about the resilience in your portfolio, really important to think about diversification, and really important to think about taking out those concentrated positions to have a more robust portfolio overall. Back to you, Darren.
Thanks, Justin, and thanks, Hetal. I'm just going to stop sharing the screen there so that we can go to the interview stage of this. Like I said, there were a lot of questions come in advance. I couldn't ask each and every single one, so I've had to theme them. And Hetal, I do apologise, because the only thing we can start on is events in the US last night. I think, you know, we put this in the diary 3 months ago. We weren't aware that this would happen, but it's quite timely. And you talked about tariffs. I think depending on what you read and what you consume in terms of media and social media and things like that, you get a different view. Everything, there doesn't seem much balance. But I'm going to ask you, really, what's the end game and what's the point? Because I think we can all read about what tariffs are, but what is the actual, what's the objective here, and why is this happening?
Yeah, I think it's a good question and pretty important for people to understand. It's one of the bugbears for a long time, I think, of not just Donald Trump, but, you know, a number of people affiliated to that part of the political spectrum, is that the US is unfairly treated when it comes to international trade. So the idea that it is you know, being almost forced to buy more goods from abroad than it sells, and I think that's a misconception, clearly, but one of the things to just bear in mind is that it's a way to try and incentivize manufacturing to come back to the US. So, you know, we have industrial policies here as well, many countries in Europe, but the idea is to try and bring that manufacturing back. So you penalize anyone that is selling into the US from abroad. And so that's, I think, been the main rationale behind it. Ultimately, Donald Trump has said at various points that he wants a weaker currency. He's kind of talked about that less recently, but yeah, a weaker currency, but wants and lower interest rates, but then wants to apply tariffs. And tariffs are inflationary, as I discussed, certainly in the short term. Further out, as growth weakens on the back of those higher prices, then maybe you can get the lower interest rates. But that comes at an economic cost. And one of the things, I think, to think long term, what do policymakers really care about ultimately is the labour market, unemployment. Do people have a job? That's I guess, for people's financial well-being, that's kind of probably one of the most important factors. And on that end, if we start seeing job losses, so far the US employment numbers have been pretty good. If we start seeing that turn, then we might see either the US government pull back on its policies, or we might see the more aggressive interest rate cuts. So that's probably the top thing for anyone to be monitoring.
I think it's important to try and make sense of it. Justin, do you want any part of this question at all?
Not really, but I'll give it a go. Look, I think that particularly when presidents have the second term, although he's talking about third term, isn't he? Although typically presidents, when they get in the second term, it becomes about legacy, and it becomes about, what they want to be remembered for. And it's clear that Trump, I think, wants to be remembered for being this chief negotiator, but also by making the US great again, I suppose, and is obviously his theme. And I think essentially that means that any unfairness that the administration or previous administrations have thought has sensed around the US, to try and correct that. What I'm not sure is this will correct it, because there's certain benefits that the US has as being this kind of world policeman, kind of global overseer, and that's just the dollar being the reserve currency of the world. So there are benefits as well as detractors of this role overall. So I think the most important thing from a portfolio perspective, though, is to think, okay, it's so difficult, and we said this before, it's so difficult to predict what politicians are going to do. So almost the only thing you can do from a portfolio perspective is just prepare your portfolio for different eventualities. And ultimately, that means making your portfolio more resilient and diversifying.
Again, prepare, don't predict. So same as pre-Trump, same post-Trump, same thing we always say to investors. Sticking with you, Justin, if that's okay. We had a few questions about European defence stocks, and that was in the news when the invites went out and things. But I'm going to shape this question slightly differently. In January, we went into 2025 with all market outlooks saying the US was the only game in town, and Europe, why would you invest? Because the last decade, etc. And in the space of two and a half months, the whole narrative has changed to, Europe over the US now. Are you finding that investors are more, and traders therefore, are more reactionary than they've ever been? Is this the nature of the modern world, where sentiment can shift in the matter of weeks here now?
I think there are a number of market participants which are more reactive. And I think when you see these bouts of volatility, it does mean that sometimes they can go on for a little longer. I think the challenge is, over the last really 10 years, you've had certain trades, certain positions which have been bankers which have always performed, like being heavy in tech, being heavy in the US, being heavy in the dollar. And people have taken, or investors have taken, leverage or borrowed to be in those positions. So when you get bouts of volatility, these positions unwind and can unwind quite quickly. And I think ultimately over the last few months, that's what we've seen. So these big consensus positions have started to be unwound. And if you're overweight something, you have to be underweight something. And the underweights have been, your Europes, your emerging markets, your Japanese yen. So you've seen these positions just flip in terms of the performance charts. And I think, I don't think the leverage or the borrowing has really come out yet completely. So actually, the last thing that's really important is then the vulnerable areas of the market at times of volatility also tends to be the most expensive areas. So really important, again, if you are going to take this longer term view, to look through the short term noise and bias your portfolio towards those cheaper asset classes overall. But definitely the world has become more reactionary. And I do think, the digitalization of investments, the fact that people can see their investments a lot more readily nowadays, does mean that there's just more reaction to short-term noise.
Indeed. Hetal, I was going to come back to you. I'm not sure if Hetal's still there or not. Justin, I'll give you another one if that's all right.
Yeah, no problem.
How we had a lot of questions around whether how our asset allocation views have actually changed over the last year or so.
Yeah,
Because obviously in the world of Polaris and in retirement funds, if anyone
yeah,
listening has got those, it's not always clear what's going on behind the scenes. Is there anything you can tell us about what's gone on behind the scenes, how this changing
yeah,
of the world has actually shaped some of the decisions we've made along the way?
yeah. So clearly, formalizing that house view has been really important over the last year. But ultimately, we've taken down our high risk bonds, so those corporate bonds, right down to neutral. And the government bonds, we were very negative on government bonds, and as yields have risen, we've become more positive on them. But also as the economic environment has developed and evolved, we just see the role for bonds if growth does slow down. We've also, as I mentioned, taken emerging markets down from a double plus to a single plus, and importantly, started to invest the proceeds in the UK, in Europe, in Japan, in those regional markets. So when you think about the portfolio overall, um, essentially the portfolio has become more diversified, more resilient, which you'd expect given our house view, or our view for 2025 is that we do think you're going to see more extremes. So therefore, being diversified, being more spread out, taking views over a wider range of investments, we think makes a lot of sense. And that's been the process of probably the last 18 months.
Excellent. I'm very conscious of time, so we're almost some quick fire questions to end. Hetal, if I could start with yours, and I apologise because I'm asking a lot of political ones to you. We were asked about the challenges for the UK economy and whether the spring statement actually mattered last week. Did it change anything at all?
Big picture for the UK is that the spring statement was probably had very little near-term implications. Most of the changes to, say, government spending come later on, 3-4 years out. There were no material kind of tax changes. I think that will come later on. The Bank of England also, I don't think, has much in terms of new fiscal news to incorporate. So I don't think it has. But further out, and even later this year, as I said, even the tariff news and how much that could affect UK growth, the fiscal wriggle room the Chancellor has it is very small, and that it could just mean that later on this year she has to announce some more corrective measures.
And almost following on from that, we are in a world of noise and constant bombardment of press and whatever it is. It's things pop up on the phone, etc. What actually matters and what doesn't is really difficult to decipher now. What are the key things in the coming months that we should keep an eye out for?
I mentioned the labour market earlier, so unemployment, very important. It also gives people like the Bank of England a gauge of where wage inflation is going, because inflation and wages very closely linked, and that's going to be key. But also one thing we keep an eye on, which gives us a kind of a few months look ahead, is something called credit conditions. So are banks willing to lend to firms, to households? Because that willingness to lend then allows for money to feed into the economy, and so far that has been improving in the UK and the US, but again a key one to keep an eye on.
Thanks, Hetal. Last one for you, Justin. Finishing on a positive here. So we had a couple of clients ask, well, if I was starting today, why would I remain invested? And I'm sort of going to ask you, what are the medium and long-term opportunities here? If you were sat in front of an investor and they're just about to start their investment journey, why would you invest today?
Yeah, so I think the first thing for me is markets can be volatile, but volatility creates opportunity. And I think that is really important, that almost the best time to invest tend to be the times when it is actually more volatile, because that's when you can get more upside. I think the second thing is, if you can create a diversified portfolio, you've seen what the impact can be just looking at the FTSE All-Share and how that's grown over time. So taking risk does lead, from a longer term perspective, does lead to increasing wealth, making sure you've got secure pension and so on and so forth. Really, really important. The last point I'd stress is, and you didn't really ask me this, but I might just correct my own question, is that if you have a portfolio, what are the areas that we're thinking about which could provide greater resilience, so best these opportunities? So we do think having more Japanese assets could be quite interesting, because when markets tend to fall, Japanese yen tends to do pretty well. We do think thinking about how much bond risk you have in your portfolio is really important. So in particular, we're looking at the short end of the bond curve, so bonds with 2 to 3 year maturities. And last but not least, I think this one is really important, given what Hetal has said. In your bond portfolios, it's really important to think about how much inflation exposure you have in those bond portfolios. So whether you have inflation-linked bonds versus non-inflation-linked bonds, and thinking about the blend of those two, So there's 3 opportunities that we're looking at. I think that's ended on a positive.
Thank you so much. Time has got ahead of us, I'm afraid. Thank you so much to both of you for answering everything so candidly. I'm sure everyone will have found something useful in the discussion. Indeed, thank you for so many people dialing in live as well. It got to quite an impressive number. However, to wrap things up, please stay safe, stay well, and we will hopefully see you all again soon. Thank you.